Welcome, my friends. The news today is that a major bankrupt Burger King franchisee has sold nearly 6 dozen stores as part of a Chapter 11 bankruptcy plan. The fast food industry is in crisis, and it's only getting worse. The fast food industry is flailing without enough workers. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Major franchisee Meridian Restaurants Unlimited just pulled out of the Burger King game. Meridian filed for Chapter 11 bankruptcy protection back in March, when it had $14 million in unsecured debt and 120 restaurants. By the time the auction took place on September 19, only 91 units were left. Now, Meridian is holding on to just 21 stores, selling off 70 Burger Kings for just over $17 million total, reports QSR. During the auction, Meridian filed a motion in the court requesting permission to close all 21 of its remaining stores. The beloved fast food chain that was once more expensive than competitors is now dealing with some pretty major bankruptcy issues. Meridian closed citing failure to recover from COVID-related complications into a post-COVID world of increased wages, increased shipping and operational costs, food inflation, and declining traffic, all compounded by the national labor shortage. The cumulative cash flow issues left the franchisee overburdened with debt. Prior to the auction, Meridian Restaurants Unlimited LLC owned just 2 brands, Burger King and Black Bear Diner. Meridian filed for Chapter 11 bankruptcy protection back in March, when it had $14 million in unsecured debt and 120 restaurants. Meridian owed significant debts to Burger King, various lenders, and vendors, and following its bankruptcy filing, the company suggested or rather insisted that the franchisee put its remaining restaurants up for sale and cut its losses. Meridian's 91 stores were divided between the Burger King Company, which bought 32 units for $4.7 million, and 4 other regional operators. Franchisee Kansas King purchased 16 units for $2.2 million, Dakota Restaurant Partners bought 12 locations for $3.4 million, and Kraft purchased 7 Arizona units for $7 million. Perhaps the most shocking figure came from Snake River Foods, which paid just $632,250 for 3 Burger King stores in Montana. Another prominent Burger King franchisee, Tom's King Holdings, which owned 90 units, also declared bankruptcy earlier this year. The beloved fast food chain that was once more expensive than competitors is now dealing with some pretty major bankruptcy issues. Meridian closed citing failure to recover from COVID-related complications into a post-COVID world of increased wages, increased shipping and operational costs, food inflation, and declining traffic, all compounded by the national labor shortage. The cumulative cash flow issues left the franchisee overburdened with debt. In September 2022, Burger King announced a $400 million Reclaim the Flame comeback plan, part of which will include shuttering 300 to 400 restaurants across America as it calls out underperforming franchisees. Similar performance issues will force Applebee's to close an estimated 25 to 35 restaurants by the end of 2023. This dissolution of Meridian's units might be a bummer for BK, but it aligns with the company's previously announced geographical concentration strategy. Burger King's business model relies on private franchisees to run BK stores around the world. Now, BK plans to handle franchisees differently moving forward, limiting operators to 50 stores, all of which must be located within roughly the same region. Hopefully, this tactic will keep large franchisees from having to be systematically dismantled in federal bankruptcy court, or at least prevent it from happening quite so often. Several different buyers are acquiring Burger King restaurants out of bankruptcy after winning an auction for the assets of large franchisee Meridian Restaurants Unlimited earlier this month. But the biggest buyer is, apparently, Burger King itself. 70 of the 91 restaurants still operated by Meridian were sold in a 10-hour auction held earlier this month, according to court documents, for a total of about $17.5 million. 4 franchisees, mostly existing Burger King franchisees, are buying restaurants in specific states. But Burger King was the largest individual buyer, agreeing to pay $4.4 million for 29 restaurants in Utah and Montana. Kraft Incorporated, an Arizona Burger King franchisee that had provided the initial stalking horse bid for the restaurants out of bankruptcy, is paying $7 million for 7 locations in that state, though $1.5 million of that is reserved for construction to repair hurricane damage on one of the locations. Kansas King is acquiring 16 locations in Nebraska and Kansas for $2.2 million, a deal that includes $1.5 million in support funding from Burger King itself. Dakota Restaurant Partners is acquiring a dozen locations in North and South Dakota, Minnesota and Montana for $3.4 million. Snake River Foods, a Burger King operator out of Idaho, is buying 3 Montana units for just over $600,000. A bankruptcy court was set to approve the deals this week. It is unclear as of yet what will happen to the restaurants that are not sold, but there are some local reports of closed locations in the aftermath of the auction. It also suggests that only just more than half of the 120 restaurants Meridian did operate before it filed for bankruptcy in March will survive the process still open. Burger King struggled coming out of the pandemic, as perpetually lower than average unit volumes proved problematic as costs surged in late 2021 and 2022 and the chain's sales did not grow like those of rivals McDonald's, Wendy's and Taco Bell. The brand closed about 60 locations last year and more have closed so far this year amid bankruptcy filings and other closures. Meridian was one of 2 major Burger King operators to file for bankruptcy earlier this year when it filed in March. And, though the company said its sales and profits were coming back, Burger King itself demanded a sale, arguing that the operator was spread too far and wasn't a strong enough operator to warrant continuing in the system. Burger King is pushing to focus on smaller operators with 50 or fewer locations, and not so far apart. In an ideal world, I'd like it if they could drive to all their restaurants, Josh Kobza, CEO of Burger King parent company Restaurant Brands International, said in May. Burger King has shown some improvement of late, however, as sales have improved and franchisees have worked on operations. The other operator that filed for bankruptcy this year, Tom's King, sold for $33 million in April to multiple buyers. Fast food is facing a major reckoning as understaffed stores, supply chain problems, and the Delta variant of COVID-19 are hitting the industry at the same time, possibly ruining plans of recovery after a notoriously difficult 2020. A new survey from the National Restaurant Association, reported by Restaurant Business Online, shows just how bad things have gotten. Restaurant operators overwhelmingly said that finding staff was the #1 challenge they face, with 75% agreeing. Of owners surveyed, 78% said that didn't have enough workers to handle business, which led to many closing dining rooms or seating areas to lower the number of customers they could serve. Nearly half of operators said that they reduced dining capacities voluntarily. According to the survey, 61% of fast food restaurants and 81% of full-service restaurants said that they decided to shut parts of dining rooms in August because they didn't have the workers to serve those areas. Business owners say they're unable to find staff and in some cases even cite a lack of desire to work, while workers say they can demand better pay and benefits in the tight labor market. Staffing issues are a problem across the country. For restaurants that are open, they're operating with fewer workers than before. Even as sales are up over 2019 levels in some cases, profits aren't. Prices of ingredients and labor have increased, and 65% of operators said that their profit margins shrunk in the previous 3 months. The bankruptcies of 2 Burger King franchisees, operating more than 200 stores, 8 weeks apart, sent ominous flares through the fast food business. The biggest issue that I think Burger King has now is they didn't have the cushion that most of their competitors had from a significant ramp-up in profitability during COVID-19, said Cardi Davis, partner at C-Squared Advisory Group, an investment bank working primarily with franchised business. Davis and Brent Elzas, a principal at C-Squared, said Burger King's U.S. business lagged behind the digital capabilities of its competitors prior to the pandemic, leaving the company poorly positioned to capitalize on the boom in off-premise sales in early 2020. I don't think that they had the right marketing and product emphasis at that point in time, Davis said. And they didn't really have a lot of momentum at that point in time, and I think other brands were more prepared. As the post-pandemic business recovery kicked in and inflation started biting, Davis said Burger King saw its margins erode, making it hard for the chain to close the gap with its rivals. One constraint on the company's ability to respond is the structure of its debt, said Cy Desta, an equity research analyst with CFRA Research. This means the company may have less room to take on the debt needed to finance expensive projects, such as the partial overhaul of its Burger King US franchise stores as part of its Reclaim the Flame program. The leverage issue is something that Restaurant Brands International has to look at, in how to restore the Burger King US, Desta said. In the low interest rate environment, it wouldn't be that big of a disadvantage, but they're doing this in a higher rate environment. It definitely makes the contrast more meaningful for the financials of the company, Desta continued. Rising interest rates have stressed many franchisees by making it harder to obtain financing at low cost, while labor costs, supply chain issues and development costs have all increased, said Eb Igram, executive director of the Tariq Farid Franchise Institute at Babson College. Igram said some franchisees across the industry may be overleveraged, whether from taking on debt to upgrade restaurants, or as a result of eroding profitability due to low sales in underperforming markets. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.